Hey guys, welcome back to Ask a CPA. Today's question comes from Ben in Denver, Colorado. Ben asks, should I take itemized deductions or the standard deduction when filing my taxes this year? This is a great question, Ben, and the answer is, well, it depends on your specific tax situation. In this video, we're going to break it down step by step and show you the two options. So the IRS gives you two options when filing your taxes. You can either take the standard deduction or you can take the itemized deduction. Now let's start with the standard deduction. Now this is a flat amount that you can deduct, no questions asked. So in 2024, that's going to be $14,600 for single filers, $29,200 for married filing joint couples, and $21,900 if you're filing as head of household. So everyone can take this amount off their taxable income regardless of their expenses or income level. Now next is going to be the itemized deduction option. Now instead of taking the flat amount, you can list out your certain deductible expenses, but here is a little bit of a catch. Each one has specific limitations. Now let's go through each of these itemized deductions and figure out the way to maximize this expense. So first, let's start with mortgage interest. So mortgage interest deduction, you can deduct mortgage interest up to $750,000 of mortgage debt, $1 million of loan origination if it was before 2018. Now, if your total mortgage debt exceeds these thresholds, then any interest paid on these amounts is going to be non-deductible. But you can still take the mortgage interest on the first $750,000 of debt. Next is going to be the state and local taxes. So these are called the SALT tax deduction. Now this allows you to deduct state income tax, sales tax, and property taxes. But there's a catch, of course. There's a $10,000 cap on these expenses. So this cap can be a deal breaker if you live in high taxable states like Hawaii, California, or New Jersey. Next is going to be medical expenses. So you can deduct medical expenses that exceed 7.5% of your adjusted gross income. For example, if your AGI is $100,000, your medical expenses must exceed $7,500 before they start to count towards your itemized deductions. Next is charitable contributions, one of our favorite deductions. So cash contributions are included in your itemized deductions as long as they don't exceed 60% of your adjusted gross income. Now that's going to be a huge deduction. Non-cash donations like clothing and furniture are going to have different rules, and they're capped at about 30% of your AGI. Now if your charitable giving exceed this limit, any extra charitable giving will be carried forward for up to 5 years. Finally, there is casualty and theft losses. Now, these are only deductible if related to a federally declared disaster. That stolen bike, unfortunately, is probably not going to be deductible unless FEMA approves it. Now, let's go through a quick example. So, let's say you're a single individual and your itemized deductions total $12,000. Now, since the standard deduction is going to be $14,600, taking the standard deduction is going to make more sense. But if your itemized deductions total, let's say $16,000, then you'll want to go ahead and take the itemized deduction. Remember, some deductions like mortgage interest, property taxes, state and local taxes, those are going to have limitations. So don't just assume you're going to itemize because you have big expenses. Now, Ben, if you're still unsure, let's go ahead and run the numbers. And better yet, ask a CPA to run those numbers for you. Guys, if you found this video helpful, hit that like button, subscribe button, and drop a tax question in the comments down below. We'll see you next time for Ask a CPA.